Hello, and welcome to the Opes Wealth Management First Quarter 2024 Markets Discussion. I'm Erin, and with me today are portfolio managers Mark Duvall and Louis Odette. 2023 ended on a very, very strong note, yet a year that was characterized by a high degree of divergence in equity returns and a huge amount of volatility within the bond market. Could you start, Louis, just giving a little bit of a background on how we saw the year play out in the primary themes?
Sure. So Christmas came early for investors this year with the so-called Santa Claus rally that began in November and took all major asset classes into positive territory for 2023. The big story in the stock market was the so-called Magnificent Seven, a group of large technology-related companies that benefited first from a pivot to efficiency and then from enthusiasm around artificial intelligence. Within the bond market, yields, intermediate-term yields, were pretty volatile throughout the year, but actually ended up right around where they started, leading to a total return pretty much in line with their starting coupon.
We know, unfortunately, it would make your jobs a lot easier if the market delineated between December 31st and January 1st, but I would imagine that a lot of both the opportunities and risks that we saw playing out last year will carry through. The question about hard landing or no landing or soft landing remains open-ended, yet the market seeming to have priced in a soft landing. The question there is, we top on to that geopolitical concerns, we have an election coming up. You're going to both be busy, I suspect. Mark, can you talk a little bit about what we see, the key things we're looking at coming into this new year?
Yeah, the main themes are paying attention to the markets and then the economy. As far as the markets are concerned, referencing exactly what Louis was saying, we had 7 technology stocks account for almost all of the performance last year within the U.S. equity market, and some of their valuations are getting a little bit rich given how big they are. When you've got just a few companies in the United States representing the entire or at the same market capitalization as all of Japan, Canada, and the United Kingdom combined, you're getting to a point where those companies find it very challenging just because of their size to actually grow rapidly enough to justify their valuation.
It would be akin to, U.S. GDP. If we're at 3%, that's considered a really strong rate of growth.
Right.
Yet an emerging market, if it's less than 10, then and it's just that sort of the gravity of that, right?
It's the size differential. That's exactly right. And so that's, there's other areas within the markets, whether it's small cap, value stocks, international stocks, that have much more modest valuations. And so we expect a little bit of a change in terms of the leadership relative to 2023. And then as far as the economy is concerned, and your comment about the soft landing.
What is it? What is a soft landing?
Yeah, it's a very good question. So a soft landing is really a situation in which interest rates can come on down because inflation's coming down, and yet we don't end up in a recession. And that's unusual for the United States. It does happen elsewhere in the developed world, but for the United States, it's an unusual circumstance. And that's, to your point, probably what's priced in. It's been, to Louis's point, the major surprise from this last year. But there's also the possibility of a no landing, meaning that inflation reignites. We're having, with all the troubles in the Middle East and the Houthi rebels actually bombing ships, then a lot of ship traffic is rerouting around Africa, causing supply chain delays and increasing costs. So that is potentially inflationary. And then on the other hand, we've got, the possibility of a hard landing. And that's really just due to, increased layoffs and less spending driven by the high interest rates that we have had finally impacting consumers and businesses. And then there's other risks that we're paying attention to, that impact the economy and therefore could impact the markets, whether it be consumer debt with rising credit card delinquencies, whether it be commercial real estate values coming down due to increased interest rates plus less demand for offices, whether it was due to the banks. I mean, we had some bankruptcy in banks, if you remember back about 9 months ago. Yep. And there's still some mid-sized banks that that have some risk there. And then finally, there's geopolitics. We've got the ongoing war in Ukraine and in the Middle East and potential other hotspots.
As is often the case, it's the thing that we're not worrying about now or no one's talking about that actually comes in, and the markets don't like surprises.
Yeah, exactly.
Right. So with that backdrop, Louis, can you speak directly to how that may impact clients, and then specifically some of the tactical shifts that we're currently implementing in portfolios as we speak, essentially?
Yes, one thing kind of before getting into portfolio specifics that I would just note is that 2023 really served as a reminder of the folly of forecasting and the risk of positioning portfolios for a single outcome, which is why we really try to design portfolios that hold up across a range of outcomes. Mm-hmm. That being said, we do make some tactical moves in portfolios and have a few ideas that we're looking at into the new year.
Could you give a couple of specific examples? You were mentioning one that really stood out to me, which was the shift in terms of our view on Japan, which has been a tough spot going back to the late 1980s and potentially seeing a shift there.
Yes, yeah. So that's an area that we really like within the stock market, just given the confluence of forces that are lining up to support it. So you've got shareholder-friendly corporate reform. You've got inflation, favorable inflation trends for the first time in a generation. Yeah. And then you've also got the yen, which has been very weak, but that will help to boost sales for Japanese companies and could be a tailwind should it go the other way. And then outside of stocks, from an asset class perspective, we find bonds flat out attractive at this point, just given interest rates have come down a little bit, but still near the high end of the past 10, 15-year range. And so we want to lock those in well we can, given Mark's earlier point about the fact that if we do achieve a soft landing, likely to see short-term rates come down and probably intermediate-term rates eventually as well.
Well, thank you both for your insights. And to everyone that joined us, thank you so much. We look forward to our conversations with you in the coming quarters. And please don't hesitate to reach out to your wealth advisor with any questions. Take care.